All right, guys, what's going on? This is going to be hopefully a pretty useful video for you in the future. Be able to see opportunities like this and jump on them. As a reminder, none of what I say in this video is financial advice. This is strictly for entertainment purposes only. Before we get into what I actually want to cover, which pertains to this trade, there are a couple updates. This update is something that I share quite frequently on my Twitter page, the trading book list. The trading book list is something that I have built over, say, almost 2 decades of trading. I think that there's a ton of value to be taken from other people's experiences, from books on trading. Some people will debate this, but I do think there is something to be said for an academic approach to markets. And books are how we've passed down knowledge since, the beginning of recorded history. People have asked me over the years, hey, what books should I read? In order to learn how to trade, in order to learn how to, do what you do. And I always tell them the same thing. You're not going to become a trader by reading a book, right? It's a combination of an academic approach, a technical approach, and being in the market, right? And having screen time, sort of becoming one with the market. There's a lot that goes into it. There's a lot of luck that's involved too, even in my own success. But nevertheless, I think that there's something to be said for passing down knowledge that you've learned in written form, binding that up and selling it on Amazon. There's a lot of books that I have recommended right off the top of the list always. And I do want to continue to update this book through time, but you'll see that retail options trading has been added. This is by Ewan Sinclair and Andrew Mack. It's a phenomenal book. I think it's one of those books where the title might be a little bit off-putting, retail options trading, as if retail really should jump into options, but it's way more than that. And this is actually way more than just options trading. I'd say 70% of this book just applies to taking risk in markets. It is a phenomenal read. Every single book on this list I've read. If I see someone who I'm familiar with on Twitter and they've written something, if I see something recommended, I will just grab a copy. But this is a great addition. This is up there with Alpha Trader by Brent Donnelly. Again, you're not going to become a trader by reading books, but listen, you're downloading knowledge by reading books. The application part is separate. There are a few other things on this list as well that are worth going over. At the end of the year, going to do another big charity drop. Guys, remember, I was sharing Woo, and the proceeds from sharing the Woo ref link, I ended up donating to St. Jude. I do get a benefit from sharing these links. I get reduced fees if I trade on the exchange, and I get the commissions. We take the commissions, send something nice to multiple charities, but specifically talking about the new promotions on Blowfin and Femex. So cover these really quickly. Blowfin is an exchange that still offers a no KYC tier. So for those of you that prefer exchanges not have all your personal information, and there is up to a $10,000 sign-up bonus. They offer spot, they offer perps. It's one of the newer options that's come up, and it's not only new, right, because there's a lot of new exchanges, but in terms of the B tier exchanges, it is a more liquid alternative. And then we have Femex. You guys know that I've been a fan of Femex for a really long time now. It's a great team at Femex, honestly. Great customer experience. They still have an $8,800 sign-up bonus, but they also are doing a VIP tier 2 for, I think, the rest of the year. So if you use these links, you're set to benefit from them. If anything, it'll help you on your fees. So I share these things. I think you guys can benefit from them. Not everyone can trade on Binance. Not everyone can trade on Bybit. All right, let's cut to the chase. We're going to be talking about this particular post. Trading means taking risk others don't want. In this case, I'm talking about liquidations, right? Liquidations like this is last night. This is the largest liquidation, I think, since FTX by notional, right? So this is notional value. It should make sense why it's by notional, rather why that amount is the largest. And that's because we're trading over 100K. Right. As long as prices continue to go up, the notional value liquidations, you could continue to have, this time is the biggest multiple times over, and it not necessarily be the case for actually coins rather than notional. So by coin, right? So by whole Bitcoins, if you measured open interest that way, this is not the largest liquidation. But nevertheless, very large liquidations present great opportunities to take the other side of them rather. And we often see this being the case in this market on the long side of things, right? Longs getting liquidated. This is a market that is obviously long biased. Markets in general, long biased for obvious reasons. Like I said, liquidations like this and forced sellers are a close your eyes and buy almost every time moment. Added that one in there myself. But what are we talking about? So liquidations and clusters of liquidity where forced trades exist. So we obviously know, if you look at this chart, right, the one thing that should stand out is that this pattern happens quite frequently in crypto. The sort of Dalai Lama pattern. You have a very sharp move down, followed by a very sharp move up, grind it out, market comes back into sort of equilibrium briefly, repinned, and then we continue to trade back up to the high or the at least all the way through the origin of the move. Now, liquidations are a result of people using leverage, right? And we know that this market has a preference for leverage, especially higher leverage. So this move liquidated everything from 10x and up. So if you're using 10 times leverage, which is quite popular and it's pretty popular as a default setting, then you were easily liquidated. Now, it was liquidations being hit and it was stops being hit. So why do we have this? Why does this occur? There are different mechanisms for how liquidations are processed and liquidation engines from exchange to exchange. I believe BitMEX still handles liquidations with limit orders. So taking those positions, placing them as, I think, immediate or cancel limit orders on the book to reduce that risk and to reduce that position further. And I think Binance and Bybit basically just turn these into market orders. So that's why you have, and I'm sure they try to keep it as orderly as possible. But when there's a bunch of open interest built up and you have sort of a liquidation cascade, it gets really ugly really quick because basically everyone is dumping into the market at once, but it presents a very attractive trading opportunity. So why does this happen? One, because people are using a lot of leverage. Their positions are path dependent. So you could have the direction right, but if you don't get the path right, you're fucked. This is why options are very useful in many cases, but it happens in the same way that people are stopped out. Why do people get stopped out? Why does the market move quite rapidly through certain areas like this where you have marginally lower highs? It's because people tend to place their stops in the same area. So if this is your low put in before this rally through all-time highs, some people place their stop locally if they're taking some kind of breakout trade. So if you long the 100K break, I've been talking about this in videos, the Hundy roll, talking about why waiting for 100K breaking was really important because you're often going to guarantee that 3% shoot to 103. So I said between 102 and 103 if 100 breaks. So for people that long the breakout, their stops are more than likely back within the range. But in the preceding move up, you could see open interest is building up into this. You had people adding well before that. You had positioning accumulate. And the logical area for people to place a stop or at least trail a stop is within this structure. You could have easily sort of dragged trailing stops for the entirety of the structure. There's very little interruption of prior lows, if you're looking at like a hourly and up chart. So what happens is these are pockets of liquidity. Like I said, sort of implied liquidity. We know when the market trades there's going to be a lot of activity because people are forced to trade. And this is sort of one of the questions that I ask myself often. Where does a market need to go to get the most people involved? Well, if we see that there's an area where there's a big pickup in open interest and there's a lot of risk that's put on, and again, it's on both sides of the market, right? It's not just longs. We know that if we trade outside of the threshold where that had built up or where that window had accumulated, we're putting someone on the wrong side of the market. Market is looking at an all-time high break. Everyone and their mother talking about Bitcoin breaking above 100K. It's pretty obvious that at some point it was going to happen. Ended up happening. I don't know if it happened because of Powell saying that Bitcoin's digital gold, but it seems like a reasonable catalyst. The overshoot, more than likely because you had stops above there for people that are creating invalidations for hedges and offloading in this range, expecting maybe we continue lower. I anticipated we hit 90K or closer to 90K before we ended up breaking 100K. We ended up hitting 90K after we broke 100K. But the idea is traders tend to place their stops in the same areas. So the areas that immediately your eye is attracted to, the swing highs, swing lows, are the areas right here, right? Preceding this move up, unless it's back in the range in this gap, you have this area here, you have low, 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 kind of places that just stand out, right? Your eye is immediately drawn to them. I'm going to place my stop below there. Well, asshole, so is everybody else. This is why I think it's useful to use if you're looking at a market that has some level of predictability in terms of what realized volatility has been, what ATR is, right? The average range of daily price movements, the average range of weekly price movements. You could place a stop that's a little bit more generous outside of those swing points to account for noise, right? Some sort of looseness in price action so that you don't get stopped out by just placing your stop below this low. But in any event, after a large amount of positioning is accumulated, whether you're 1.5 ATR, 2x ATR outside of this, it's like once this gets hit, the market just unfolds rather quickly and you have sort of this cascade effect. Again, so people tend to place their stops in the same areas. When you have a big pickup in positioning, you have stops getting hit, you have liquidations getting hit, and the larger the amount of open interest that you have built up, the more likely the move is to be violent. So I've said this numerous times. When it comes to open interest, it's not absolute levels of open interest that really matter. When the market is trading within a pretty defined range, you'll often see that the absolute highs and lows tend to sort of mimic a range themselves. So the market will, and we've done this numerous times where like a very large range where it is pinned, again, wide consolidation, but ranging price action, you will see that often we do have a threshold for positioning, right? So the market approaches prior highs, prior highs and open interest, sort of an area where you expect things to possibly exhaust if they have in the past. And it's a cutoff point. And the same thing for exhausting positions to the downside, wiping out positioning. You'll see that again, it stays relatively bracketed, and you could use that. And again, that is looking at sort of an absolute level in open interest, but absolute is not necessarily as important as, a sharp pickup in a short amount of time. So this will qualify. So over the span of, you're looking at about a day, you had a massive jack up in open interest. So that is position that is pocketed, right? And it's through a very significant level. It's through a key psychological level. Again, you had the Hundy roll. The thing about knowing about a Hundy roll is that is what you get. The Hundy roll is a trade. It can happen through $1 to 103. It can happen to 10 to whatever sort of a 2-3% throw is above that. The target for this was basically 103 max. And a lot of people are taking that trade. So you have a good amount of positioning built up for the breakout. You have a good amount of positioning built up for a trade that is, I don't want to say guaranteed, but it's a great trade. It's not maybe a pocket aces trade, but it's maybe a aces tens or an ace kings. Don't even quote me because I'm not much of a poker player, believe it or not, regardless of being, I would say, a decent trader. Don't want to be boastful by any means. But anyhow, you had this pickup, sharp increase in open interest. The setup was primed for a large liquidation to take place. And, you have a key level that we broke up and above and then lost. The market's trickling back within a range. This happens so many times across different time frames. Look at this fractal, a breakout through a range, market hangs out, it should continue, right? It shouldn't revisit, it should get up and away. And when it starts to roll over, it's a sign that maybe we have a little bit of trouble ahead before we end up moving higher. So we force sellers out. And what happens because of that, when you have this massive liquidation, you end up removing future sell pressure. So don't forget, when longs build up, and this is why when your pool guy gets in crypto, when your taxi driver, whatever it is, when the market is full of longs, the market is full of future sellers. Once you take out a bunch of longs and sells are realized, meaning they hit the book, there's less sellers in the way on the way up, right? And you might even have, sideline buyers at that point. People ante back up, buy back in. So you tend to relieve a little bit of pressure in markets. This is why you'll hear the phrase, markets need to sell off before they go higher. And this is why a lot of people are talking about this being a healthy move, and it is. You don't want to see this continue to build up and price not based out. So a large liquidation took place, and by all means, this is a very large liquidation. And this trade, just to tell you in advance, you could begin to just back test, right? Do an eyeball test, go through Bitcoin's price history, and look at either very large wipes in open interest where a bunch of positioning was liquidated, or use a liquidation chart and look at the extreme liquidations over time and how the market has responded after. And I'll go into that right now and why it's such a, I don't want to say it's a gimme, but it is. It's why this has become a meme. The fact that this has become a meme, it means that it's really reliable. And it's a mechanical trade in such that the first people willing to take this risk are going to be rewarded the most. And it's not like this is going to be arbed out of the market. I mean, it'll happen faster and faster. You have to understand that after a big move happens like this, it's very unlikely that you're going to sway a majority of the market to getting back in after something really ugly has happened. So this will always be available for a small amount of people because I think people just get scared out of being in position. And again, you've sort of changed things at a mechanical level. You've created this sort of gap or vacuum that exists in the book and makes this trade easy to take place. To understand how this works, you have to understand, for example, how an order book works. Listen, everyone here should know how an order book works. They should know what the limit order book is, what a bid is, what an ask is, what a market order is, what a limit order is, how market moves from one place to the next. Market orders being responsible for moving price, limit orders mostly being responsible for shaping price. Your larger traders are going to be using limit orders. Your smaller traders are going to be using market orders. When you exercise market orders over a range of prices, you create more sensitive participants, or the participant has more sensitivity to movements. You're creating an entry across multiple prices if you have too large of size, and it's just not optimal if you're a larger trader to do that, obviously. So the one thing I want to touch on about a limit order book is how it would work. The limit order book on both sides, if it was populated evenly, right? Let's say in this case, we're looking at the Binance order book and there's 200 BTC for sale in the offer up to 5% and 200 to buy in the bid down 5%. And let's just imagine that markets are very random, which obviously no, they're not. And let's throw orders at the book randomly. So if you threw orders at the book and the book on both sides was even, the market would have trouble going anywhere, right? You'd see periods where it went up, periods where it went down, but if it's even, it's not going to really trend. If the order book is really skewed, if you had one side that was completely empty and one side that was really stacked, even if you threw random orders at that book, you're going to get a move that's directional, right? So we have a ton of liquidity in the bid. It's a bunch of people looking to buy using limit orders, and we have nothing in the offer. If you just threw orders at the book randomly, random size, random interval, that price will trend up over time. Why? Because it's going to eat away more at the offer and travel upward, then it will have an effect on the bid, which is more stacked. If we look at what happened yesterday, there's a couple levels that I marked out and I've labeled them: prior day open, prior day low, prior day low, all-time high open. So what happened? There was a very large liquidation on OKX. Markets were quite broken for a bit. There was really large dislocations between the spot markets and the perp markets. If you look at, for example, this is the difference between Coinbase and Binance, really large spreads. So almost 1,000 points. So basically a percentage, which was very wide to see that take place between exchanges. This is a 5-second chart. So what you'll notice is we're looking at a move that moved down very rapidly. If you looked at a tick chart, it would be really interesting, but I can't look at tick charts for all of these. TradingView doesn't offer that. But you would see that there is a ton of trades that took place into this, and then the few trades that took place after had price movements of really wide ranges. So market makers quoting really wide, spreads blowing out. There's more ways than one to tell there's a ton of liquidations that took place. You had the lows being taken out, you had really rapid price movements and a ton of liquidations and spreads blowing out. So it's more obvious on Coinbase if you look at those 5-second intervals than if you look at other exchanges. This took place in a matter of 2 minutes. So once we broke this prior day's low and cascaded into that low, we ended up taking out a lot of that open interest. So yes, we hit sort of a 10% threshold from the highs, liquidated 10x and above obviously on the way down before that, having tighter invalidations, and then you hit those stops. We take out all that positioning and you can see there is really clearly capitulatory volume into the low. So on the way into that, price had already broken below 100K. The range was really tight, volumes evened out, and it was clear that prices were accepted. When prices have really wide ranges, it's a sign they're not accepted. So when price is moving down and ranges are really tight, it's a sign, especially when it's just uninterrupted, that price is being accepted lower. In this case, it was not much of an acceptance. It was a violent move down. So all that open interest comes off. On the way down, books are cleared. You have a chart that looks completely broken. It's obvious, honestly, to tell these just from looking at the chart. You don't even need to look at open interest. You see a chart that has this kind of range in such short amount of time. Look at the 1-minute chart. That is the bulk of it right there. That is the break below the final low. That's where things really start to cascade. This is 3 minutes of movement. That's the final minutes range. So 96 down to almost 90K. And look at the amount of volume that takes place into that low. And this is important because you have that much volume creating that much of a range. You look at spreads blowing out at the lows. You look at the basis between exchanges completely blowing out on the way down, and then briefly flipping before continuing to blow out. Coinbase trading much higher than everybody else. And this presents a really attractive trading opportunity. Why? All it takes after this is for prices to briefly stabilize. So things are moving very quickly. Exchanges are very dislocated. If you looked at a footprint chart, I'll show you the peak of lows of this. You have 5 zero prints from 91.8 down to 96, sort of classic blowout, ass never falling down completely, barely any volume done into that final low, and then the market pauses. So it's the first time that you have any kind of pause. You could use a minute chart if you want. This is something where tick charts and seconds charts reign supreme though. What you want to see is ultimately after a massive liquidation like that, and again, it's going to take a bit of nuance to it and discretion because you're looking at something that took out all the lows. You have one of the largest liquidations. You have capitulatory volume. So you have to take this jump without complete information. But all you need to do is see things temporarily pause. And then the first green candle that I get long under the impression that this is going to move back to the point of origin. So the point of the major breakdown, which is where the cascade began right here, it's going to move back there really easily. And this is the best way to illustrate that is for this move down. This is the amount of volume that was required to move prices. And on the first move up, that is half of that, you have less volume moving prices to get to that point than you had here with a wider range. You could slam size into this, but there is a limit because if you're not getting filled that limit and you're taking that market, there's nothing really for you to take. That's why prices move so rapidly. It's an inefficiency in a gap that's created. So it's an air pocket. So what happens is all of that volume is put into the low, all that positioning is taken out. There's really no longer any sell pressure. Markets are really dislocated and it takes nothing to move it back to the point of origin. So you'll see that prices moved up and they moved up on declining volume and they moved up quite rapidly. And it's because there's nothing in the book, right? It's not like that book had any time to repopulate. So when I see something like this, there is obviously discretion to it. So you're looking at it and you say, that was a massive move, right? We haven't even gone into the fact that it was a $10,000 move. This is not even something you'd need to see a liquidation chart or an open interest chart to discern because it should be pretty obvious that you've taken out the low And if you've watched this in real time, you know that the price action is gross, right? It goes from point A to point B faster than you could adjust. And by the time you're selling, if you're selling at that point, you're getting filled across a range of prices that don't exist. And it's going to be the worst possible slip you can imagine. So what I do is wait for basically the first pause. You had no pauses on the way down. And if you're trading on Binance or Bybit, it's quite clear when there is a throwback. Let's say your throwback is the first one and we went to like a 30-second chart. This is how much time passed. That gives you a great entry signal as well. First green bar, it's like pin bar for people that are reading technical analysis books. First green bar, the amount of volume that was put into that and the fact that we closed at the low, that is reason enough to get long. And your target for this trade is the point of origin. This is ultimately my target right here. So where does the gap begin? And this final low and the break of that low, you can see there's clearly a change in character there between how price is moving here and where things got really slippery there. So that is ultimately the first target. For those of you that want to treat that as an area to manage the trade, that's reasonable. But for me, I take most of the positioning off there, but I also jam in as much as possible. But I had stink bids across exchanges that were filled and ended up basically taking me out of that delta neutral position. I ended up having to add more in manually after. But this is a time is of the essence trade. And again, there's a reason why this meme is so popular in crypto. It's because it works. It leaves a gap in the book that can't repopulate fast enough. And I shared a thread on this earlier that presents a really attractive trading opportunity. And this is something that we've seen happen countless times. It happens across multiple time frames. Just happens to be when you have this happen on the high time frames, it's obviously going to have the most meat on the bone, present the best opportunity in terms of the amount of size you could put on it and what you could expect to see back from a trade like this. But this is a case of the market basically breaking temporarily and you being willing to step in when things are looking like shit and no one else wants to step in, you being willing to take the risk. Even if you didn't want to take the exit off of a technical, right? So taking it off of a level being retraced, a gap being filled. One of the things you could do is monitor markets basically returning to sort of equilibrium. So you could see this is where things were really wonky. I mean, Coinbase was trading well above everybody else. Markets are broken temporarily. All that gets arbed away. And then we're back to sort of even keel and normalcy, basically by the time you recover that gap anyway. But yeah, hopefully this is valuable. It's a little longer than I wanted, but they're going to chop this up. And yeah, be sure to check out the exchanges that I mentioned. Check out the book list. And if you have any questions, comments, concerns, leave them below.